everybody. It's 5 after. I think we'll start the program now. So first of all, I'd like to welcome everybody here to our webinar today. My name is Tom Lyons. I am responsible for communications and content here at Gen2. And today we're talking about boosting fund distribution with tracker certificates. And we have a panel of three great guests with us today, one from Gen2 and two from a client of ours, Loyal VC. So we're going to try to make this webinar both informational in a technical sense, but also in a practical sense. So the gentlemen from Loyal have been nice enough to join us to talk about their actual experiences with trackers, with fund distribution issues, and also with the product that they've done with us. And we hope that that will be informational also for you. If you do have questions, please put them into the Q&A chat, not the regular chat, but the Q&A chat, and we will definitely get to all the questions, or as many as we can at the end of the webinar. If it's okay with everyone, I prefer to do Q&A at the end so we can make sure to get through our content. So this webinar explores how fund trackers can help VC and private equity funds reach new investor segments by reducing distribution friction. The premise behind this all, or our supposition, is that you can, even if you have a great performing fund and a great sort of value proposition on your fund, doesn't always solve all of your capital raising issues. Distribution bottlenecks can occur in different areas, and tracker certificates can be a way to get around them. And yeah, I think we'd like to jump right in first, really quickly, so the participants dialing in know who we are. I'd like to have each of the panelists introduce themselves, starting with the Loyal VC guys. And Kamal, since you and I have just met 15 minutes ago, why don't we start with you, and then over to Michael.
So, co-founded Loyal VC with Michael. I spent 20 years as an entrepreneur, 15 years of that angel investing, 7 years of that first running, then designing accelerator programs. I had the career my father approved of beforehand when I was a engineering physics, engineering with IMAX, INSEAD MBA, and then worked for Bain & Company as a consultant. But rapidly discovered I preferred small companies to big ones. Michael.
Great. Michael?
Yeah, Michael Kosick, lifelong entrepreneur, industrial engineer by first degree, INSEAD MBA by second. Did a short tour of duty at a big Canadian bank, angel investor for many years. And Kamal and I worked together in a variety of different capacities over the years, including at a startup, on the alumni executive for INSEAD, and at the Founders Institute. And 10 years ago now, we were talking about problems and opportunities in early stage investing, thought we could do things a little bit differently, maybe a little bit better. Launched Loyal, and great results to date, and now upwards and onwards with Gen2.
Great. Goran?
Right, my name is Goran Gusic. I've joined Gen2 about 2 years ago. I'm running the UK office for Gen2 as part of our UK or international expansion. My previous career have basically spent 2 decades plus on the capital markets, as in kind of trading equity derivatives for large blue chip banks, mostly across the world, really across the globe. Started in Switzerland and then moved through Europe to Asia and back to the UK. And yeah, now helping really financial intermediaries of all sorts, kind of trying to helping them securitize or assetize their projects and bringing them to the market, making them bankable.
Fantastic. Okay, so the first theme we'd like to get into is what I'm calling the distribution challenge. And I'd like to start with you, Kamal, and Michael, from the Loyal perspective, without giving the answer away of how you solve the problem, because we're going to come to that in the third segment. I'd like you to talk also a little bit about Loyal in more detail, and maybe some of the distribution challenges you were facing that led you to come to us and set up this product. So barriers and things like that. So over to either one of you.
So look, Michael and I built the fund that we wanted to invest into. And that we ended up doing venture differently, both a different fund structure for the investors and a different approach to investing to serve the entrepreneurs. One of the big things we did is we structured this as an evergreen fund. So it's an evergreen quarterly semi-liquid fund, which is pretty common these days. You're starting to see it in other asset classes in private equity and infrastructure, credit, private credit, et cetera. Still a little rare in the venture capital space. But when we did that, we didn't realize, I mean, we did what we wanted ourselves. We thought, liquidity is a good thing. Why should you be locked in for 10 years? Why can't you trade in and out at par? Why do you have to liquidate on a secondary market at a 30% discount if you want to trade out of an asset? So to us, it seemed like a good thing, but we rapidly discovered that this is a very good thing for individual investors. For the institutions who traditionally invest in venture capital, it really wasn't an attractive structure. It was too sort of exotic, something they weren't used to. They didn't know how to diligence, et cetera. So we rapidly discovered that we were selling our fund one by one to individuals. And that, while it certainly works, I mean, we really need to get distribution partners in place. So that was sort of the challenge we ran into. Michael, I haven't talked much about how we invest. I don't know if you'd like to take that.
Sure. So being a forever fund, we really believe that time reveals all. So we start with a very small investment. In fact, these first checks, we call that our pilot stage. We have over almost 500 companies now, 483, I think, that take these small investments. You can almost think about this as paid due diligence. 95% of our capital is in follow-on. So this is very different than typically in the industry. So we have our network filter the deals for us. We source primarily through INSEAD, the Founders Institute, and our own investors. We make small investments. We do the due diligence over time, and then we deploy capital afterwards into the best performing companies.
Can you, I'm curious, guys, can you go more detail into actually the two things you talked about, Kamal? First of all, why were the institutions having such a problem with this? And what were you doing distribution wise on the individual level? I'm assuming those are QIs, right? It's not,
yeah. So it's accredited investors. So it's an accredited
investors,
investor
yeah,
only
of course,
product.
yeah.
Yes.
So I'm curious. Maybe we can go more detail into that kind of
Sure.
friction.
Well, let me quote one of the institutional investors we spoke to. So we spoke, of course, as an analyst who screens all the deals, and the analyst at the end of our meeting said, "Really great approach to investing. I really think it's going to make money. This small first checks, the follow-on, the diversification, the sourcing, it's all great stuff you're doing. I think you'll make money. A really smart way. I haven't seen anyone else doing venture like this. But it's going to be too hard for me to explain to my investment committee. I'd have to use up all my political capital to just bring this in front of them. And it's just not worth it to me as an individual to burn all my political capital trying to explain something which is so different." And that is really, I mean, you end up with this sort of agent principal challenge in a institution, which is the agents who work for the institution really, they're worried about losing their job if they take a risk. And you don't get fired for investing in BlackRock. So why would you invest in a no-name fund? I mean, we're an 8-year-old fund right now. And even as an 8-year-old fund, it's not a household name. How do I defend it if I'm being called up? And of course, the paradox is, we run in venture capital, we are an early stage venture capital fund. We invest in early stage companies. That is what the industry traditionally does. And it's an asset class within pension plans because it has been such a successful asset class over the past decades that people look at this and say you get excess returns relative to the public market from investing in venture capital. If you do it intelligently, and the institutions all know this, they invest in 30 different funds to get a diversified portfolio of venture funds, because traditionally venture funds are specialized. We've invested in almost 500 underlying assets across sectors around the world to give you that diversification. But they know it as an asset class. What happens is, if you are a large brand name group, you don't want to deploy hundreds of millions, a couple of $100 million in a fund that doesn't give you enough in fees. You want to have a multi-billion-dollar fund. So they basically brand late stage venture. I saw a investment in a household name company with over 2,000 employees. of $300 million, which was called a late stage, was called a venture capital investment. And it just really, they're doing it because they want to attract money in the asset class. And we're sitting here saying, look, venture capital, early stage, you're smaller firms. Because you're smaller firms, you're not as well known as a brand name. And then the challenge is to really build that distribution out, because we don't have an army of salespeople around the world the way a BlackRock does for their funds.
Yet if you look at the demographics, the numbers, the wealth, there's as much wealth in in private hands for the high net worth, ultra high net worth, as there is in all of institutional pension, sovereign wealth, and endowment combined. So and yet and we call this the venture capital paradox. And often, if you look at how endowments invest, they'll do equal weightings in venture capital, in private equity, in U.S. public equities, and international public equities, in fixed income, and in real estate. And their goal is to create wealth and preserve wealth. That sounds like a pretty good goal, not just for endowments, but for individuals. So it comes down to why are the mass affluent not allocating similarly, and it's a function of access and education, and both of those things are being solved in a variety of different ways, and I'm sure we'll talk about some of those. But that's why the focus on the mass affluent. We've got a great product for them.
And if you don't mind me asking, how did you sort of approach distribution at the beginning when you realized this?
Well, so look, we're entrepreneurs. So the first thing you do as entrepreneurs is you talk to the people that know you the best. And our first half of our LPs were folks saying, Kamal, Michael, maybe I don't really understand this, but I trust you guys. Here's some money. And the other half were like, no, this is a fantastic way to do it. Everyone should be doing it this way. I commend you guys. You guys could make money easier doing it differently, but I really like this. And here's my money. And then we build brands within our communities, and that attracts people. We build a reputation, so we start to get a little bit more inbound. But look, we add 6 companies a month. That's one every 5 days. You do that over 8 years and you end up with 500 companies. We do that with individuals and we end up with over 250 individual investors currently in the fund. So but to Kamal's point, we really want this to be able to scale and continue to scale. And to do that properly and in a diversified manner, we need to work with wealth management.
Speaking to the sort of the working with your communities, we have been very much sort of a best kept secret in terms of we've got about 60% of our investors are alumni of INSEAD. So you have some really top people, well, in our investor group, not all of them alumni of INSEAD, but you have people like sort of UBS senior vice presidents, someone from, you've got someone from a place like Pictet, you've got all these different, really sophisticated individuals who are looking at this. And this is a product which has been for sort of the insiders who know us already, the elite, because as a small firm, we don't have a lot of marketing. Whatever marketing we do is within our communities, and INSEAD alumni, that has been one of the largest communities we're in. But it's sort of all these insiders get to see it. And we're really trying to go out to give others more access to this. We hear over and over that from people who would like to do venture capital, but they find the venture capital products they're being offered are too specialized, are too risky because they are so specialized, and they're also too illiquid. And for 98% of venture capital funds, it's just assumed you're going to be in a liquid fund. And we've said there's no reason that should be. And yeah, as I've said, you're seeing these evergreen semi-liquid funds in other asset classes. There are challenges to doing it in venture, which we have sort of overcome.
Okay, so excellent. Thanks, guys. So basically, to sum up, great product, great idea, lots of interest. The barrier is getting it out there on a larger scale. And with that in mind, I'd like to turn to you, Goran, to talk about the tracker certificates, which we do a lot of here at Gen 2, and maybe just start, and which will then obviously be the solution to Loyal's problem. In this particular case, maybe talk about just start off with what they are, and we'll take it from there.
Well, tracker certificate in this context really are used as kind of feeder structures. And what do I mean by that? We're basically kind of institutionalizing an offering to give people access, investor access to the funds. So via a SPV or a PCC, SPC, depending on the jurisdictions, protected seller company or segregated portfolio companies, which we create so the issuance vehicle which is subscribing into the fund. So you have one investor per se, as in kind of investing via subscription into the fund, and the shares or the tracker certificates that are issued are representing the value rights or the underlying asset per se. So the investor buys it through his bank, puts the money he likes, or the amount he likes, and gets the performance returned to him via this certificate. Now, the difference here is like on one side, you have a debt structure, which is the certificate, compared to the direct shares that are held by the SPV, that is a subscriber into the fund. So what does that mean in reality is like, we are really cutting down or streamlining all the onboarding processes, the KYC, AML, etc. That is all outsourced to the bank. So the investor's bank. The bank will know the client, the bank will have dealt with the client before, and allows the client to buy into the product. Means you can basically kind of democratize the product per se, as in kind of the burden or the cumbersome work that you would normally have identifying a client, etc., to bring him on your cap table. That is not necessary. That is done by the bank on one side, and you have one subscriber into your fund, which is the SPV that we help you create.
Okay, and this question I've always been curious about. I mean, what does tracking actually mean in this case, and what's the difference between this and just buying a share?
The tracker will be, as I said, is a debt instrument on one side, right. So it's kind of a one product per se. So you're gonna get the value rights of the fund, so you get the NAV transmitted, and you have the performance of the fund replicated via the tracker certificate. So if I buy in today at 100, fund performs, it does is 5% or 10% a year. My NAV minus fees, minus costs, etc., will represent that new value, and this valuation comes via fund admin or external valuations delivered to us, and then delivered into the banking world, into the custodian or the custody account of the investor. So he will see it on his bank account that he has. So rather than holding a piece of paper, a contractual agreement that I've bought into it, I have it in an institutionalized format through the security with an ISIN, registered on the exchange, etc., and bought via the bank.
Okay, great. And if I show up at your door, Goran, one day as a potential client interested in setting up a tracker for my fund, what's that going to look like for me? I'm trying to get to the question of what's the process like? How complicated is it or not? How much time are we talking? What do I need to do?
Gen 2 has done so many different products since the start, since 2018. So trackers being one part of them. Essentially, there's different ways of doing it. I think if you go for the full setup where you control the issuance vehicle, etc., so we set up the issuance vehicle for you. We put in the directors, trustees in place who will be overseeing this issuance vehicle. Again, Guernsey, Caymans, different jurisdictions can be picked. Paying agents get involved. As in Gen 2, we as a company, we don't touch the money. All the money flows via paying agents, which are regulated parties, mostly in Switzerland, but we also have international partners in the setup. So from a bank perspective, from an investor's perspective, you go to your bank, you have a term sheet in hand. I would like to invest into this tracker. That is a specific ISIN. I would like to put my money in. Money flows to the paying agent account. Delivery versus payment. You get the certificate in exchange for the money. The product manager, whoever is sitting under this, who has been denominated dedicated product manager, he will release these workflows, release the money into the fund. Fund will use this money or deploy this money, these assets according to the fund mandate. whatever the fund mandate is, and that is all defined in the term sheet as well. So as in kind of you can't just wildly act with other people's money, as you can imagine. So you will have to follow the rules and that are defined or predefined in the term sheet. So time to create this can differs a little bit. Mostly is like due to due diligence processes of the parties, the connection to the individual elements, i.e. paying agents, directors, and trustees to get their approvals and so on. But we're aiming normally like kind of, say, 4 to 6 weeks, I think, for a tracker certificate from the onboarding of the issuance vehicle to the point that you have a security ready for subscription.
Okay, and I can also make use of a Gen 2 issuance vehicle, correct?
You can. So that is the other setup. So if you don't go for the full issuance setup, we have issuers that we have created for exactly this purpose. They're off-balance sheet structures, and you in Luxembourg a very common thing to rent compartments. Here you're basically getting a cell from an existing issuer, and they're fully segregated. There's no risk contamination between the different cells coming from the same issuer, etc. So you have your cell, your ISIN, your term sheet, and that is basically kind of your investment vehicle or investment structure to funnel money from the investor to your fund. So what you're going to see is going to be the SPV or the issuer subscribing into the fund. On the issuer level, we're going to see that money is coming from a UBS, from a Pictet, or from a bank, Julius Baer, etc., into the paying agent account, and from there deployed. So there's no visibility who the individual is buying into it. Hence, also from our side, there's no KYC AML necessary to identify the individuals putting money. Saying that, it is really a product for professional clients only.
Yeah, of course. That's assumed in all of our products. Okay, Kamal and Michael, back to you guys. So something brought you to us, and to wanting to solve the distribution friction that you were talking about before. So maybe you can get a bit into that. And again, I don't want to. This webinar is not supposed to be an advertisement for Gen 2, but I wanted to sort of do that journey and what sort of motivated you, and what was the specific time? Say, okay, let's try to do a tracker, or how did you get to this structure?
So the first thing is that Switzerland has been a key market for us already. If we look at our existing individual investors, something like 20% of them come from Switzerland. So we naturally thought, how can we distribute better through Switzerland? And then, of course, the handicap for people who want to invest in our fund right now, and we've already heard this from Swiss individuals, was, look, I have to come to you directly, sign your subscription agreement, work with your fund administration. We outsource to a third-party fund administrator to do all my KYC. This is a headache to do. And oh, by the way, I'm doing this despite my banker, because now I'm doing something that my banker isn't really managing. I would love it if I could just tell my banker, buy loyal, and my banker could do everything for me. And from the banker's point of view, they want the asset to show up within their existing systems to be able to just print out the client's account, which includes all the client's assets. So for us, the distribution through the banking system has been really big, because this way the private bankers can buy it easily for their clients. And for the client, it's a simple way to buy. It's one quick call to their bank.
Michael, anything you want to add?
No, I mean, bang on. Like we can't be samples of one. When you look at what the customers want, what the channel wants, it's reduced friction. So something that looks like what I'm used to buying, something that fits into my existing processes. It may, we are adding extra plumbing, if you will. But it's allowing for this necessary, water to flow through the system. So for us, this just made sense as a thing to do. And we met with one of the founders of Gen 2 years ago at a wealth management conference. There was a meeting of minds there in terms of the trajectory that Gen 2 was on, and where we were going, and we just stayed in touch. And then as this market it has matured, so this is not just a fad, but something that is here to stay, and something with continual tailwinds behind it. We just chose to go with Gen 2 because of the market, because of the solution, and because of the people involved.
And look, we've got very aligned philosophies as firms, because it's really about making alternative investments available to the masses, not having them be something which only the largest institutions, the wealthiest family offices can invest in. Why don't we make this available to everyone? And you are very much providing the plumbing to allow that to happen in a number of alternative assets. And we've been sort of focused on our singular alternative asset, early stage global venture capital. And that has been, so there's real meeting of minds there. So of course you want to, when you find another firm which has the same mission as you do, it's just sort of a match made in heaven.
Okay, great. But that said, did you look at other alternatives? Or before going this route, and did you sort of look at the environment and say, okay, we could do this, we could do A, B, or C, or how did that work?
Yeah, I mean, there's a lot of hurdles to jump through. Really, what we heard over and over in the EU is, look, we are a Canadian registered firm because of the favorable tax situation. People don't think of Canada's favorable tax. It just happens that for limited partnerships, which we are, it's a pure flow through. There's no taxation at the Canadian level, and Canada does not. At the entity level, limited partnership, and also Canada does not taxes based on residence. So foreign LPs in our fund don't have any tax obligations to Canada. So we thought, wow, this is wonderful. We can sell internationally. What we heard over and over as we started to approach markets in Europe is we needed to have a European registered fund because of all the challenges. So our alternative to the tracker structure would have been to set up and to register a Luxembourg entity or similar ourselves, go through all the hoops, all the cost of replicating all the legal, of doing all of that work ourselves. And it's just much more cost efficient to work with someone like Gen 2 to build the tracker than it is to actually set up a second fund entity with all of the necessary legislation, qualifications, et cetera, needed to do in a market like Europe.
All right, and I'm curious, then getting back to the product we've done, how so Goran explained the process in theory. How did it go for you guys, and what surprised you about it, if anything?
So I'd say one thing that happened, and this was just a necessary part of being listed, being a product listed on people's shelves, is we did some unusual things. So for instance, we take a carrier performance fee at Standard and Venture Capital. We were taking our performance fee on exit when the people, we basically said, why should we take a performance fee if the performance goes up and then it comes down again and then bounces around? You should pay the performance on what you actually received out the other end. But what that means, of course, is you never know the performance of the fund fully because it's up today, down tomorrow. So how much are you, the individual, going to pay? And the other thing about the tracker is, as mentioned, the bank, we have Julius Baer subscribes to units of the fund. We don't know which of their clients is subscribing, so we could no longer do that. So we actually had to set up a new class of funds, which worked in a much more traditional way, where we're taking a performance fee on a quarterly high watermark basis rather than deferring all the fees to the end. So we just needed that new class of funds. So some of this we didn't expect. We had always thought, oh, we're treating people well. But when you look at the essentials of the plumbing, which is you no longer know or track who your investors are, then you can no longer say this specific investor stayed with us for 10 years. They pay based on where they came in and where they left, as opposed to, if I don't know if they stayed for 10 years or 2 years, how can I do that? We also have an early exit fee in the original fund to encourage people to stay in for at least, a period of up to 4 years. I mean, after 4 years, there's no early exit fees. But again, we could no longer do that. So we had to come up with a new class of funds, which had the characteristics which allowed it to easily be listed in a bank platform. And we had always thought, oh, we're entrepreneurs, we'll do it differently. Let's do this, it's better for the investor. But we realized there are reasons why it's done a traditional way, and the units which are being tracked by Gen 2 are a very traditional structure, like most other funds do it. And we ended up there because we had to do it to sort of fall into the system.
That's right.
Can I maybe ask a question, Kamal or Michael? How do you provide liquidity to the investors? As in kind of, are you allowing them in and out, as in kind of early stage before there's an actual liquidity event or an early redemption, etc.? How does that work?
Yeah, it's not guaranteed, but there's a liquidity sleeve. Kamal, you want to explain that?
Yeah, so look, we are officially what's called a semi-liquid fund, which is, and this is what most evergreen funds are, because when people trade in and out, we are not liquidating the underlying assets. In a traditional fund, you buy a bunch of assets, you liquidate all the assets, and you give the money back to the investors. And in our case, these are long-term assets. So we are effectively swapping over the ownership of the assets from one buyer to another, one owner to another, just the way the stock market works. I mean, Amazon doesn't sell their data centers to liquidate investors. You get a price and you trade things back and forth. So yeah, the semi-liquidity, on the Class B units, which is the units which are being tracked, there's a liquidity sleeve, a target to 10% to the liquidity sleeve. Whenever there's a liquidation of an asset, that money goes to refill the liquidity sleeve to allow people to trade in and out. We use new money in as reserve for trading people in and out. So you've got the new money in addition to the liquidity sleeve, in addition to the distributions. And we're an 8-year-old fund. I mean, we've venture assets. Because it's an evergreen fund, you have this pool of assets which is continually aging and growing over time. You're adding new assets all the time, but you've got your existing assets maturing. So we're making the past 3 quarters, we've made distributions back to our investors. So we've had cash being created. We've also been running this fund for 8 years. We didn't run it with a liquidity sleeve initially. If we had had the liquidity sleeve would have been sufficient to allow everybody who wanted to trade in and out without ever having to wait. But what we've done in the traditional fund, and what could happen in this fund, is you might have to wait a quarter to fully trade out. You might not be able to trade everything out in the quarter. So, I mean, with all semi-liquid funds, it's semi-liquid for a reason. You'll generally have liquidity, but you can't count on liquidity the way you can in the stock market. So that's really the warning. Yeah.
Kind of going back to Kamal's earlier point about us continually adding assets and the assets aging within the fund, is that long-term steady state, this will actually start to look like a venture annuity, or put differently, the distributions from regular exits of the portfolio companies will start to look and track to the IRR of the fund. So that will create that consistent money out. Now, of course, that's going to vary from year to year and where you are in the cycle. Some years you're going to have more exits, others not. But fundamentally, the mechanism is there, to Kamal's point, to not have to sell the data centers.
Okay, great. So excellent so far. We're starting to get towards the end, because I definitely want to get to the Q&A, because there are actually a lot of questions coming in. But before that, Kamal and Michael, I'd like you to take a step back from Loyal. Let's say you're at a conference, or you're at a roundtable with other GPs or other funds, and they're interested in your experience. So the question is, in your opinion, what types of funds could benefit from trackers, and maybe a little bit, what are the key trade-offs that they might want to consider? I mean, you've already talked a bit about your own experience there.
I mean, the number one thing I'd say to any other GP is you want to be on shelf. If you want to sell to individuals, selling direct is time-consuming and inefficient. You want to be on shelf with a wealth manager or private bank. So find out what their shelf is and do what you need to do to get on it. And I would certainly say a group like Gen 2, that's what you do. You're creating products which are on shelf immediately. So it makes it a lot easier working with you. But that would be my generic advice.
Yeah.
So one thing to add there, one of my favorite lines in that context is kind of what is a tracker is really replacing the contractual agreement between the GP and LP with an institutionalized solution, with a security. And that does make life easier for pretty much anybody involved, be it the GP or the LP on the other side.
Mm-hmm.
Are there any times when you would say, or any conditions under which you'd say maybe this isn't the right structure to get to the
Sure, you have to look at what your underlying product is. I mean, Michael and I, from day one, designed the fund we wanted to invest in. So we designed a product for high net worth individual investors. If you were a traditional illiquid venture fund, for instance, where you're a sort of locked in fund, you could be on shelf and no bank is going to tell their clients, invest in a product where your money is locked away for 10 years and you can't get it out. It's just too hard to explain to their clients. So I would absolutely, so I wouldn't waste my time. I would, and it's what we did also. We talked with Gen 2 and we said, well, here's the product, here's the features. And during the process, Gen 2 came back and said, well, hold on a second. This is how it works. You aren't going to know who your investors are, so you can't charge a fee which depends on when that investor bought and sold. So yeah, you're going to have to adjust the product to fit what's needed for people.
And are there cost implications for you?
I mean, we spent a bunch of money on lawyers, yes.
Okay.
So, but there's the cost implications on the lawyers, and of course there's an overhead cost to the tracker fund. So we have to build that overhead cost of the tracker fund into the fees we're charging. But we heard, I mean, remember talking a couple of years ago with one of our people who was at a private Swiss bank, a Swiss banker. They've actually invested their own money, and they were looking at offering loan to their clients. So they wanted the experience themselves as the private bankers of just, let's discover this product, see if it makes sense. Let's be in it for a few years, test it out, and maybe then we can offer it to our clients. And I remember talking to them. I said, look, imagine for a second, and we're certainly less than this, but imagine for a second, we were at a 2 and 20 fund originally. I said, imagine that it was a 3% fee, but it was on shelf in your bank. Would you care that it was an extra percent higher? And he said, no. It's like, I just need it on shelf. And even it was a 3% fee, and we've come in at a 2.5% fee for this product because we're trying to really manage the cost as well as we can. But that, as far as he was concerned, an extra percent really didn't matter. He needed a venture product on shelf to offer to his clients.
Look, and this is going to become, more efficient and easier to do and launch additional funds. So if you have and trackers. So if you have a strategy which you're going to be building, either multi-fund or like us, we might have special opportunities funds in the future that focus on a particular geography or a particular sector, then adding or bringing that to the channels as we build out brand and to our investors and making that accessible and quickly filling them up. We may choose a standard structure for some of these special opportunities vehicles. Having that distribution in place will expedite and make that growth part more efficient in the future. So I think that if you have a multi-staged strategy in mind with a product that might have some non-conventional features like loyal, then these are mechanisms that you should look into today. Because they're only going to get more powerful, and in many cases you want to be first because it's that market's going to crowd out as well.
Thanks, Michael. That's great, and I think that's probably an excellent point at which to stop with the formal part of this webinar and move over to the Q&A. And just to show you how punctually Swiss I've become in life. We're exactly at where we wanted to be at 45 minutes before going into the Q&A. So I'm not sure what that means, but that's where we are. So we've got a fair amount of questions, and I hope we can get to most, if not all of them. The first one I'm going to just take a shot at for Kamal and Michael. I'm asking this question because at least it came in at least twice. I'm assuming it's both times from a compatriot of yours, because the question is basically, can a Canadian purchase these AMC units from Canada? Are there how does a Canadian participate in this tracker AMC? Are there any brokers in Canada? So somebody's curious about that.
That's a good question. We've never expected that question. We have an exempt market dealer in Canada. You can certainly go talk to your wealth manager. We've got an exempt market dealer partner here who processes trades in and out of us. So I guess it comes back to, do you as a Canadian have an account in a Swiss bank? If you have an account in a Swiss bank, then your Swiss banker can buy it easily. Yep. If you only have accounts in Canadian banks, I actually don't know. We haven't looked at how a Canadian bank would buy this product. But I'm glad we're getting the question, because it shows there might be a demand for it. We just didn't think of there being a demand for it.
Good, and we can
will
take
go
a look
away
at
and find out.
But
if you have an account in a Swiss bank, just buy it through your Swiss banker.
Yep.
Okay, and staying with you guys, the question is, how do you explain this structure to a potential investor who's never encountered one before? So, like, what's the pitch?
It's like a mutual fund.
No.
Yeah, that's the easiest. Like, if I was to cut down to the simple line to start off with, so you buy. Look, you're getting access to very early stage investments. Companies are staying private longer. When you buy into Loyal, you get a piece of every past investment we've made and a piece of every future investment we will make.
And for the tracker structure itself, as far as the clients are concerned, it's effectively transparent. They care that they're buying the underlying performance of Loyal VC, the fund. They don't care if they're buying it through a direct investment in Loyal through a tracker, which then buys units of Loyal. They're still ending up with the same asset. So we don't even need to explain anything. It's just like, you're buying the asset Loyal VC. It just happens to be in this track. You don't even explain it's a tracker. It's listed on Swiss listing.
I'm a proud owner of 7355651, which is the Swiss IC number. It's Loyal.
Okay.
It is a structured product. It is a structured product, a private placement. So that's one thing to consider. So that's maybe kind of a bit more specific on that front. But it's effectively it's the same as buying an ISIN like any other ISIN.
So, guys, has this helped? This is another question. Has this helped? What I'm hearing is the simplicity of it, the straightforwardness of it. Does this help opening doors for you, getting to more people?
So we know the demand is there. We're just launching now, and we hope to transact soon. So ultimately, we'll withhold our judgment based on money in the bank. That's what we tell all of our entrepreneurs. You have to prepare the ground and make the deals with the distribution. But ultimately, it's it's customers voting with their wallets. People need to be willing to pay for this consolidated view. This access to this asset class, and Loyal's got to be the right thing for them. So, we understand that we still have relationships to build, and we're very open to finding and building relationships with the right private banks and with the right wealth managers. And part of our issue, going back to when you're choosing products and distribution, is right sizing that. So we know exactly how much capital we can deploy as this model matures. So we want to make sure that we can satisfy the demands of the wealth managers for their particular clients. I guarantee there's always a subset of clients that are going to be that this market that this product is perfect for. But it would be nice if there was full shelf demand across all of their clients. So we're open. We want to have those discussions. Please approach us.
Great. Next question for all of you. Is there a minimum fund size where this starts to make economic sense, or is it more about the distribution ambition than the AUM?
So yeah, I mean, yes, of course, there's always a minimum fund size. You have to do your math, like figure out, and I'm not going to say what we pay or what our costs are, but figure that out. The discussions with Gen 2 are all fairly transparent in terms of, what it looks like, what the costs are. So figure that out, figure out what your economics are. For us, we knew that this is part of our continued trajectory. The core loyal fund will probably be about a $500 million fund, making $50 million of investments per year. But these special opportunities funds and vehicles will enable us to take advantage of the capacity we've built and scale the AUM significantly higher. So, like in all things, the break even, comes hopefully in months and not years. But yeah, figure that out.
Okay. Next question. I understand that a tracker is a feeder structure into your evergreen fund. Who manages the in and outflows between the two structures, and how is it done? Do they have to be aligned from a subs reds cutoff point of view?
So yes, there. Who manages it? I mean, the fund itself. The fund itself is the one which accepts the money in and then gives the money back out. If there's ever going to be a gate, the gate will come down between the Canadian fund and the tracker structure. So yeah, I mean it's a who manages it. I ultimately I guess the fund is managing, but there's certainly a lot. There's a relationship in between. Goran, you're nodding your head. I don't know if you have anything else to add to that.
No, I think it's exactly that. It's like everything ultimately comes down to what your fund mandate is, and that's what you do. So you're going to get the money in, and you're going to deploy it. As a kind of the investor per se is not choosing what companies you're going to pick. He's going to give you the money to do what you do best. Pick your companies, pick your bets, and off you go according to your mandate. So yeah, you are managing it ultimately.
And look, we have multiple class. I mean, we don't just have money coming in from the feeder fund. We also have money coming in from other investors as well. And we basically treat everybody the same. So if there's going to be whatever the rules are, the feeders investing in our Class B units, and however other Class B people are being treated, well, the feeder fund is being treated exactly the same way.
I think that's part of the early conversation we had here is the SPV, the issuer who's subscribing into the fund, is just another investor. So he has multiple investors feeding into the issuer, and the issuer is the subscriber. So he will be treated like Goran subscribing or Michael subscribing. It's the same. So we have the same treatment on ISIN level as you would have as an investor going direct into the fund.
Yeah.
So the next question is near and dear to my heart as a representative of Gen 2. It's to who do we contact directly to discuss the opportunity of issuing an AMC for our investment idea? The answer to that is that yes, Goran, we will be sending out an email after this webinar with all our contact. So everybody on the call will be getting a link to or very easy way to get in contact with. And please do. We'd be very glad to hear from you. Next questions on distribution limits. Are there distribution limits on the distribution side? Who can be a customer? EU retail, which I don't think, with 100K plus or less, US, UK, QI only, etc. Anybody want to grab that?
I mean, I will certainly say that the underlying fund itself as a Canadian fund is only licensed to sell to accredited investors, accredited or qualified investors. Now, those accredited or qualification rules do change a bit by country, but this is, I'll say unfortunately, because I don't necessarily philosophically agree with limiting the access of investors to products, but it's the law we have right now, which is it cannot be offered to the general public. It needs to be an investor qualified under whatever your local jurisdiction is to buy the product.
I've got a gripe about that as well. It's a function of wealth that these rules are written under, and not a function of education. So that's unfortunate, but that's how they're written, and we are a law-abiding fund.
Yeah, or as a percentage of wealth. I mean, I've heard quotes about this. It's like I can go to the guy in the U.S. says I can go to Vegas and I can gamble away $100,000 and nobody's stopping me, but I can't put $10,000 into a fund. It's like, why not? Why is there limits on my ability to gamble? And there's no limits on gambling, and there are limits on whether I can put a tiny amount of my assets into any one fund.
That's a commonly raised question that we are facing, I think, kind of on a fairly regular level.
Okay, I'm going to take one or two more. We're getting towards the end, but I think we might have touched this, but I'll go back to it. From a distribution standpoint, what are the biggest challenges in getting private banks comfortable with these certificates?
So, yeah, go ahead.
I mean, I hope none, but I'm going to throw this out to Goran.
Well, it's really kind of your mandate, your story, your experience, and your track record. Eventually, it's like kind of is the investor as a professional, qualified investor. He will choose, he will pick. So the bank per se, they have a security in front of them. I think the biggest hurdle we're seeing with banks is that they're acquiring an asset while they're fighting the capital outflows. They're not going to see the capital outflow, but they're acquiring an asset that they can't borrow or lend against that in most cases. So there might be a bit of a pushback on their side on that level. But per se, no, it's an ISIN as any others. And it's a private placement, yes, but it's an ISIN that they can book and they'll be able to purchase in the name of the client.
Right. So again, that's the great answer, and the answer that I wanted to hear in terms of there's no a weaker perceived ISIN. An ISIN is an ISIN is an ISIN, right?
Correct.
Yes.
Okay. Last one, guys. Is the question is if the liquidity of the tracker is the same or different from the underlying fund?
It'll be identical to the underlying fund.
Class B shares. Yeah.
No.
And all the associated rules and rights and mechanisms. Exactly the same.
Okay. Well, in that case, gentlemen, I'm going to wrap it up. Thank you all very much. I think we had an interesting conversation. We went the whole hour almost, and it felt much quicker to me. And hopefully it did to you and to the audience. Looks like most people stayed for the full time, which is always great. I think, or I hope that it was a good conversation in terms of being, like I said, theoretical, but also practical. And gentlemen, Kamal and Michael, I really appreciate you guys spending time with us and giving us your own personal perspectives. And Goran, as always, it's great to chat with you. And with that, I'd like to say thank you all and goodbye until next time.
That was a pleasure. Thank you very much.
Thank you, Goran.
Take care.
Thank you all. Bye,
Bye everyone.